And welcome to the Investor Coaching Show. Paul Winkler, along with Mr. Ira Work, talking about the world of money and investing. Lots of people talking about the election being called. There's still some up in the air about that, so who knows? But you know what I think is interesting is just the conjecture about what might be coming as a result of a presidential change. And I've talked a little bit about, we've gotten into a little bit about how, well, this QE thing, that article, I think that was the most mind-blowing one, most mind-blowing thing that I've seen all week is about how quantitative easing has affected the stock market over time, and that estimate just blew my mind. Ira was just looking at those numbers again and just going, wow. They're talking about quantitative easing, which was a big thing under Trump, which was the Federal Reserve buying bonds and trying to drive interest rates down and trying to help out with the economy in that way. And you have a disconnect between the Federal Reserve and the government. It's not a government entity. But just the estimate that without QE, that the NASDAQ would be closer to 5,000 than 11,000, and the S&P 500 closer to 1,800 versus 3,300. And as I've talked about, it's people saying that the market is just so hot, it's been so great, and blah blah blah. And I say, which market? And my point always being that the S&P 500, the Dow, and the NASDAQ. Those big U.S. companies, which are most popular with American investors, yeah, they've done really, really well. But it hasn't been the market overall that has done well. And it, typically what we found, as I have talked about many times, is the stock market in general tends to do better and has historically done better under Democrats than Republicans. But it's done well. Don't get me wrong, it's done well under both. But the reality of it is that historically the returns have been a little bit higher under Democrats versus Republicans. Now, that's not to equate the economy with the market, because some people say, well, isn't, a lot of things that couldn't it be hurt the economy? Remember, we don't equate those two. You could have a terrible economy and a great stock market. You cod have a terrible stock market and a great economy. They're not necessarily together with each other. And people's ability to predict is pretty bad when it comes to the stock market, for sure, because we see that the vast majority of professional managers can't figure out which stocks are better than others, because we see that 92 to 93% of professional managers with large U.S. stock mutual funds can't match market returns, and we see that 96 to 97% of small cap managers can't match market returns, and they can't predict direction of the market either. And that was the actual the topic of conversation with the Intelligent Investor this week. Jason Zweig says, blown election calls. Blown election calls, the stock market. Did you grab that one too, Ira? Did you find that article?
When was that one from?
There was, I don't know which day he put this, but it was blown election calls, the stock market, and you.
I have another one from Jason Zweig.
Do you have another one from him?
But different. It's actually from today.
All right. Well, we'll take that in a second then, because I thought this was good in regards to the election. He says that the election has you doubting political experts. Use it as a reminder that maybe you don't know everything either, especially when it comes to investing. People watching election results on the screen near the White House this past week, they had, talking about what the election was going to turn out like. And what they said here was that the words every pundit should have said earlier this week are the same ones every investor should have on their mind most of the time. The word should be, I don't know.
That's what it says here, too.
Yeah, is that right? Okay.
Yeah, it says these words every pundit should have said earlier this week are the same ones every investor. Right.
Yeah.
I don't know.
I don't know.
Go ahead.
Yeah, all the pollsters and the people on the cable news who are predicting the blue wave, or conversely, a landslide for President Trump, were wrong. They were, Fonzie always had a hard time with that word. I'm wrong. Famous episode from Happy Days from the 1970s. And Stuart, you're way too young.
Well, actually, that's what I tell when my clients become a little like antsy. I'm like, you need to just turn on Happy Days.
Yeah, there you go. Yeah.
Just watch reruns of Happy Days.
Oh, that wouldn't be a bad
because
idea.
This is what paper did you get that out of?
I don't know. I printed it off. That was something I saw that came up on my screen on my computer. I was going through the Wall Street Journal.
Oh, okay, because it's a different title.
Oh, really? Okay, interesting.
Same exact article. I'm reading it word for word with you.
Same stuff, different. Okay, yeah. The other paragraph that I thought was interesting was one: individuals have a critical forecasting advantage over professionals. I thought this is, and I'm like going, individuals have a forecasting advantage, and at first I'm thinking this paragraph's really screwed up. But as I read it, I go, oh, I see what he's saying. Right. I see what he's saying. He's making sense. A guru who often says, I don't know, won't be invited back on the cable TV show or in a public platform, where consistency, certainty, and confidence matter at least as much as accuracy. I don't know if accuracy matters, because if they're wrong, nobody will remember.
Yeah, but you see, we talk about that. Like, if somebody on TV comes out and says something and it comes true,
right?
We look at them as a guru,
right?
But if they say something that doesn't come true, they hope you don't remember.
Yeah, and if somebody on the channel actually holds them accountable, I'm shocked.
Oh, they're not held accountable.
Well, sometimes I've once in a while. I've seen it once, maybe twice.
And in the 30 years you're in this business?
Well, that's true. That puts it in perspective. Yeah, it's you're right. They're normally not held accountable. So what they said was, it says, however, you, the general public, in other words, he's talking about here, are free to admit your ignorance and change your mind without losing face in front of millions of people. But, you might lose face in front of a couple friends that heard you say something that didn't come out true, but they probably won't remember either. But, here's the thing. We don't mind losing face, here, us, Ira and I. We don't mind losing face when it comes to predictions about the market, because we don't make predictions about the market.
I actually take it one step further when I'm talking to my clients or talking with a potential client, and that is, we are bold enough to tell you we don't know.
Right.
And if it ever comes to the point where it sounds like I'm telling you I do know, then it's time for you to move.
Yeah.
And go to somebody else.
Yeah. And, the reality of it is that you don't have to be able to predict the future to be a successful investor. That has been our message for 20 years. And, the issue is that, you'll have people come out, well, we think this is what you got to do right now. You need to go and, need to get a little bit of safety right now. Somebody told me that this week. Somebody said before this past week, the comment was, you know what, you need to move to the sidelines. And I had a conversation with this person on Friday. I said, glad you didn't listen to that information, aren't you? Because it would have been a really bad week to go move to cash.
Yeah.
Because and people were severely tempted to do that. Because, hey, who can blame you? I mean, it's an election week. It's, a lot of talk that if Biden gets in, the market's going to crash, and that there was all that talk. And that was one of those things that in all the debates, and I hear that, I'm going, oh, please just stop. People don't know. You don't know what the market's going to do. You have no clue.
Well, I think that his next sentence really summed up what you just said. The trick is to embrace uncertainty without fooling yourself into thinking that impetuous decisions can give you control over it.
Yeah. Embrace uncertainty.
Embrace the uncertainty. I don't know what's going to happen. I know we've studied this stuff. Paul, Ira, Jonathan, Evan, Arlene, Ann explained to me that this is a diversified portfolio.
Right.
You're in 21 different asset categories. They've been tested based upon academic standards, Nobel Prize winning theory.
Mm-hmm.
The portfolio is designed to handle the ups and downs of the market.
Yeah.
The other part of what we bring into that is the behavioral finance, what's really driving the individual investor, so that we can help them stop from making those impetuous decisions.
Yeah.
And I know one of the things that I learned from you years when I came back, when I came up here to work with you is, it's telling the client, talk to me about what you're thinking about doing before you do it.
Mm-hmm.
Because I might not be able to help you fix the mistake after it's done.
Yeah.
And you then tell me.
Yeah.
But at least if you come in and we talk about it and you still want to do it, at least you're making the mistake with your eyes wide open.
Yeah. Yeah. And that's critical. So with the election, and we're constantly, what's going to happen is we're going to have new information that will come out. You may say, well, we think we know who won the election now. And there's some debate regarding that, like I said, as to what legal actions are going to be taken, how long it may take, and those types of things. But the reality of it is the information about who is going to be in there, what the Senate's going to look like, what the House is going to look like, all information is constantly being digested. And the market will be completely unpredictable, but the reality of it is most of the time it goes up, and it goes up more often than it goes down. And Novembers, I've talked about how most of the Novembers in election years, you have a significant move up in markets in most of the election years. And what I think is going to be really interesting going forward is that as conversation takes place, there'll be rational minds that come in and say, hey, you know what, maybe it's not time to do any kind of a tax increase right now. Maybe it's time to just a little bit slow walk this because, politically we can't get it done. You can say that this person is going to be in office, but you can't tell me what is going to be negotiated as a final outcome of any legislation regarding taxes, regarding changes in plans. We're talking about another type of a COVID bill coming out. We don't know how big that's going to be because that's all going to be negotiated. We don't know what companies are going to be benefiting. We don't know what companies how they're going to respond to new information that comes out. Companies may be, changing their business plans, and that if you're any kind of a CEO, you had a plan for what if Trump gets in again. You had a plan for what if Biden gets in. So companies are going to be implementing their plans, and they're going to be doing it in such a way that they maximize profitability for themselves. That's their job. That's their only job. And that is, one of the reasons that I don't keep up at night regarding all of this stuff. I mean, a day after the election, I talked about this in the first hour. The day after the election, I was sitting up in my little room, having my breakfast and having my coffee like I always do, and, not watching any of the news. I tuned out. I completely tuned out of any of the talking about how the election turned out, what's going to happen next, who's in, who's out, what is the outcome of this. I tuned it all out, and I sat there in silence, looking out a pane glass window at deer playing in a field, and knowing and thinking, wow, they don't have a clue.
Well, do they care?
Nor do they care. And isn't that the way we are supposed to be when it gets down to it? When you diversify broadly and you follow the academic principles that Ira was talking about, you don't have to worry about it. I can't tell you how many clients have come to me over 20 years. Because I can't tell you that over my 30 years in this business that I've done it right from the beginning. But I can tell you over the past 22 years that it has been diversifying, following academic principles to the T, and really not just owning lots of stocks, but owning different areas of the market that move in different dissimilar fashion historically, and doing it at as low cost as we possibly can, and really being cost conscious in doing it. I can't tell you how many times in the past 20 years people have come in and go, I don't worry about it anymore. And you know why they don't worry about it anymore? Is we taught them so well what they were doing before they did it, that they knew that market fluctuations would occur. They knew exactly what to expect, what they were doing, why they were doing it, what to expect, what all the costs would be, and they knew how it all worked so well that when news comes out and things happen, they're just like, you told me this would happen. And I think that's the key to education. when you're an educated investor and you understand how all of this stuff happens and how the portfolios are put together so that no matter what happens, there's always something in your portfolio that's doing okay. Did I know it was over the past 4 years it was going to be large U.S. stocks? Heck no. If I'd known it was going to be large U.S. stocks doing better than everything else, I would have put every dime there. I am not willing on my life to bet you that the next 4 years are going to be that by any stretch of the imagination. Not only because of the presidential turnout, but even if Trump won again, I wouldn't have bet that. Simply because nobody, like I said in a previous show, nobody would have guessed that Reagan, one of the most American-centric presidents of our lifetime, would see in his second term international stocks trounce U.S. by such a wide margin.
What you're saying here, come March, I'll be in this business 37 years. Mm-hmm. And I would like to think with everything that I know, which is a lot in this area,
fairly significant. Yeah.
I would be able to maintain discipline myself.
Right.
But I look at the international markets right now being so low.
You're tempted to buy more of
that,
aren't you?
I would probably say to the managers who manage my money, which is the same managers that manage our clients' money.
That's right.
Just put as I make my monthly retirement deposits, put it into international, put it into emerging markets, because they really have not performed.
Yeah, that's
where
right.
the conversation I have with clients is, why are we even in international anymore?
Yeah.
Because you have to be.
Right.
You want to be diversified, because international, when that takes off, you're going to be sad you weren't there.
Right.
And that's what we saw happen to a lot of people in 2000, when 1996, 7, 8, and 9 were just awesome for the U.S.
Right.
And then the U.S. took a dump and the internationals went up and totally outperformed the U.S. markets for the next 10 years.
And the example I always like to give was when I got in the business in the 80s, it was all my compatriots are coming around me telling me, Paul, forget about U.S. stocks, put all your clients in international, because that was 2 decades of outperformance.
Mm-hmm.
And, after the first decade of outperformance of international, you would have been tempted to do what? Go U.S. then.
Right.
And then it was another decade of outperformance. Now, who'd have thought that it was going to be 2 decades in a row? And then, who would have thought that that U.S. after, 5 years from 1990 to 1995 outperforming would have gone for another 5 years. And then, you just don't know how long it's going to go. The market doesn't have a memory. It's one of my favorite Burton Malkiel lines. The market doesn't have a memory. And what he means by that is that the market doesn't care what just happened over the last year. It doesn't care what just happened over the last 3 years. It doesn't care about what happened over the last 5 years or 10 years. The market is priced right now, based on what is likely to happen, based on all knowable and predictable information in the future.
Maybe after 96 years, the market just developed dementia. It doesn't remember anything that just happened.
It might be. And if we have a cure for dementia, the market won't take it. You are listening to the Investor Coaching Show right here on Super Talk 99.7 WTN. Paul Winkler along with Ira at Work. We'll be back right after this.